we really appreciate the opportunity to really talk about the vision for what Arbitrum is. Arbitrum is a business and how we intend to continue to build a strategy to support the business and as well as developers, builders, building within the ecosystem. I think it's a very important place to speak and talk about the economics of launching layer 2 blockchains versus layer 1 blockchains. Because in many ways, this is the fundamental basis of the strategy that we have moving forward. And I want to talk about a couple of different components when you launch a layer 2 blockchain that are structural advantages. What I like to call the superpowers of launching a layer 2 blockchain, because it's the basis, like I said, again, of the strategy. The first is, and it feels like it's not an important thing, but honestly, it's actually very important, is that you pay variable costs for security versus fixed costs. And the reason that's important is you don't have, and this is particularly important in terms of enterprise growth and what we're seeing with a lot of the enterprise blockchains, especially institutions that may not want to launch tokens, is if you launch a layer 1 blockchain, if you look at some of the competitors today, they're spending between hundreds of millions of dollars a year in order to get this blockchain off the ground. Sometimes even I think Solana currently is spending about $8 billion a year in network inflation in order to support the security and the validator set on the network. Arbitrum has to pay zero. The way Arbitrum economics work is for every dollar of transaction fees generated, about 3% of those fees are paid to Ethereum layer 1 for security. I think Ethereum's undercharging, personally, but as a customer, I'm not so unhappy about it. But that allows you to build a business that is modeled around how much am I trying to gain from a revenue perspective. It also allows you to ensure that you don't have startup costs. And if you decide, for example, as an enterprise, I want to deprioritize our chain and continue our on-chain journey, the opportunity costs are much lower. You don't have a noose around your neck. Because what we see many times is they might want to deprioritize a chain, but they don't want that chain to be insecure because the brand reputation associated with that can be quite high. The second thing is when you think about that 97 cents that I just described, that 97% gross profit margin, the question is, what do you do with it? Layer 1 blockchain architectures pass it through to validators because they have to. They don't have the ability to retain those assets. So what does Arbitrum do? After you pay Ethereum for security, the other 97 cents goes directly on-chain into a treasury wallet controlled by token holders. The only way to have that ETH move out of that treasury wallet is an on-chain vote by token holders. Obviously, a majority have to vote in favor in order for those assets to move. So you can retain earnings in the treasury, which allows you, which is the final bullet point, to build a sustainable compounding growth mechanism for the ecosystem. You can take that, instead of paying validators, instead of having token inflation issuance for security, you can take your profits that you're generated and continue to grow the ecosystem. I'll spend a little time on this, but the parallel of you launching an L1 is you have high upfront costs and fixed costs on validators. Whether you generate $1 in revenue or $100 in revenue or $1 million in revenue per day, your fixed costs might be $500,000 in validator inflation issuance. You have to pass through all of your revenues, so you don't get to retain anything for growth or for a rainy day, and you can't retain those earnings. These are the structural advantages that layer 2 blockchains have, leveraging Ethereum for security. Just keep that in mind for a second, because that theme is going to play out through the rest of this presentation and our vision for how we intend to both build a sustainable business for Arbitrum, support builders, and grow the ecosystem. What I want to just talk about also now is what is the value proposition and what makes Arbitrum different. Arbitrum as a platform sits in a very unique place in the industry. Many organizations, institutions, enterprises, DeFi teams, DePIN teams, whoever you are, they'll come to us and sometimes they'll say, this is our product. We either want to launch a chain or we want to launch on a public chain. And when you talk to a lot of our peers and competitors, some of them have a very high throughput L1 blockchain. And if you ask them, they'll tell you, you have to launch on a public chain. No one should ever have their own chain. In a lot of ecosystems, they have a SDK which just launches chains, and they don't have a core robust public blockchain. And they'll tell you, launch a chain, it will be in your best interest. Arbitrum is unique because we have industry-leading products across both. Arbitrum One, which is the public instantiation of Arbitrum, is a top 5 blockchain by economic activity. The Arbitrum Orbit stack is one of the 3 or 4, maybe even 2 most adopted stacks by industry. So when you talk to Arbitrum, we can talk to you about what is the best thing for your product. There's many teams that came in and said, I want to launch a chain. And we said, you're not ready for a chain. We recommend that you launch on a public chain. There's many teams that come into the ecosystem and say, I want to launch an Arbitrum One, and we tell them for your use case, you should probably launch a chain. And the ability to say both of those things is unique. There's really no other ecosystem and platform that can offer them a deca-billion-dollar liquidity environment as a secure, credibly neutral public chain, and also a very highly adopted chain. And this is one of the unique things about the Arbitrum platform. But how do we also differ technically? And this goes back to how we think about Arbitrum Everywhere. So one area that we discussed is big public blockchain, as well as a stack. We want to be able to support you everywhere along that journey. We also want to be able to support you anywhere in your journey in your development. So right now, the big question that developers face is, do we want to leverage the EVM or do we want to use other programming languages? We see the EVM, I think, is the strongest moat that has the Ethereum ecosystem generally. Thousands, tens of thousands of developers, robust battle-tested DeFi protocols, and a lot of tooling and infrastructure to leverage. The challenge is, as we bring more institutions on chain, is that a lot of them don't have Solidity developers. We see this all the time. I met with a large insurance company, for example, and they said, none of our developers know Solidity, and we don't want to have to hire Solidity developers, but we want to be able to leverage the EVM. What should we do? And Stylus is something that we've built. It's been in production around 1 year, and it was about a 4-year engineering effort to get it live. What Stylus is, and there's workshops going around throughout Buenos Aires this week around learning it more technically. I'm not the right guy for that, but Arbitrum has full EVM compatibility, but it also supports other languages that compile to WASM. It's very similar to the eWASM initiative that the Ethereum Foundation had about 2018, 2019, but has since been deprioritized. But what makes this amazing is it allows you to leverage the entirety of the Ethereum virtual machine, all the tooling and infrastructure. But if you want to write your contracts in Rust, you can. If you want to import cryptographic libraries that would be too expensive in the EVM, you can. And this is not like a separate Arbitrum chain. Every Arbitrum chain can choose to launch with 1 virtual machine or 2. The public Arbitrum One chain today does have full support for Stylus, and we're starting to see more and more developers taking advantage of it, writing in Rust C. So this is one of our core differentiators, and we think will help us as we continue to position ourselves as the convergence of TradFi and DeFi. This flexibility that we have, the product that we've built, has allowed us to have a very broad and robust ecosystem. Our core areas of strength are RWA and institutional adoption. Many of you may be familiar, we partnered with Robinhood where they're issuing tokenized stocks exclusively on Arbitrum. And BlackRock, Franklin Templeton are historical other examples of institutions that are leveraging Arbitrum for their growth on chain. We've also seen a lot of adoption in stablecoins. So a lot of the stablecoin platforms, USDT Zero and Paxos, for example, are building interoperability as there's more and more blockchains coming on chain. They're both utilizing Arbitrum as their hub chain. What does that mean exactly? All of these transactions, if you go, let's say, from Unichain to Berachain, that transaction settles on Arbitrum. And the reason a lot of them choose Arbitrum is because of the same principles we described when talking about Arbitrum One: secure, liquid, decentralized, fast and cheap, and confidence that this will be a great place for them to be able to build a sustainable home for the core of their infrastructure. We've started working more closely with gaming and consumer teams. I would say gaming in particular is an area of strength. And most importantly, I would say Arbitrum is typically known as the home of DeFi. We're continuing to support and leverage that use case. Perp dexes have found a lot of their product market fit on Arbitrum since we've launched. Originally GMX, Gains, and others. Hyperliquid first launched on Arbitrum, sources all their liquidity from Arbitrum. And most recently we're seeing, for example, that, Ostium Variational continuing that trend. Ethereal is another one that launched as an Arbitrum Orbit chain on top of Arbitrum One. So we continue to think about how are we get convergence, how do we bring more assets on chain into Arbitrum and support trading activities and the best builders. Arbitrum One end of that platform barbell The largest L2 by TVL. It's held that position for almost 5 years. This year to date so far has been $200 billion in DEX volume. Similar volumes, if not slightly more, in perps as well. We have more than 1,000 DeFi Llama apps and 2,000 I don't even know how they got that number, to be honest, but at least 2,000 applications have launched on Arbitrum and tens of millions of addresses. And the other side of the barbell, there's 45 chains that are deployed on mainnet that have been using the Arbitrum technology stack with $20 billion bridged, hundreds of thousands of developers, and more than 80 million wallets. And the thing that makes the Arbitrum Orbit stack unique is like that same mantra said, Arbitrum Everywhere. There's people who are launching Arbitrum chains as L3s on top of Arbitrum 1. You have L3s on top of Base. You have L2s on top of Ethereum. You have L2s on top of other ecosystems. Our vision is Arbitrum should be the best execution environment platform for you to build whatever your needs are. And that's our thesis. So that's about a little bit about ecosystem adoption, some of the advantages of using the Arbitrum technology stack. What are the businesses of the Arbitrum technology stack? And these three business lines are what I like to call our natural resources. And you'll see the differentiation when we get to the rest of the presentation. The first one we discussed briefly. Arbitrum, today it's about like closer to about 95, 97%. But historically, Arbitrum 1, for every dollar of transaction fees generated, about 93% plus goes directly on-chain into the on-chain treasury wallet. And that's the first one, we call that transaction fees. The second one is Time Boost. Time Boost went live in April, and it really is it was an intense research effort of our team to try to figure out how do we internalize MEV. The two historical approaches, the first one was adopted by Arbitrum historically, it's called first come, first serve. The way it works is if somebody sends a transaction to the sequencer just processes all of the transactions in the order it receives. The benefit of this historically was that it's fair and it protects users. Whoever came first went first. There are two problems with this approach. The first is the most sophisticated traders were basically almost always first and took advantage of all the opportunity. And the second is the real profit maker of this functional setup was actually like AWS and other infrastructure providers. Because what was happening is the sophisticated traders were paying massive amounts of money to either co-locate with the sequencer or try to get as fast as possible to the sequencer. And essentially nobody was internalizing that revenue. The other option historically has been priority gas auctions. And a lot of EVM chains use that mechanism. The issue with that is it opens opportunities to certain back-running, front-running opportunities that might be a little bit more malicious forms of MEV, and it doesn't democratize and protect users in the way that we were looking for. Time Boost is something that we built, which we think is an elegant solution. We're still iterating through certain forms of it, but at a high level, the way it works is you have the regular lane of transactions, and then there's a second lane, almost like a fast lane. And the way it works is there's an auction every minute today in which somebody can buy the rights to be in the fast lane for 100 milliseconds. And the way it works is you don't get to see the transactions in the other lane, but you just know that if your transactions are here, you will be 100 milliseconds faster. So it allows the ability for people to project what opportunities might be available and to bid on the right to that fast lane. But again, it doesn't allow users to get front run. It's more a mechanism for other forms of arbitrage or backrunning that might be less malicious in nature. To date, it's generated a little more than $5 million for the Arbitrum DAO, and all of those funds as well go directly on-chain into the DAO's treasury. The last is the 10% share, and this is a unique one. There's a lot of different approaches to how we should think about the sustainability of ensuring you're not going to have your business disrupted, but also have your technology distributed everywhere. And there's been different approaches, and the approach that the Arbitrum ecosystem has taken is something we call a community source license. It's actually, I think, personally quite elegant, but we've been getting a lot of feedback on different ways to improve it. If you want to launch your Arbitrum chain as a layer 3 on top of Arbitrum 1, it's totally free, permissionless, and you don't have to talk to anyone. Just do it. A lot of chains have done this. Ape Chain's a good example of one that has chosen this form and mechanism. There's another option though, again, the goal is to make it permissionless and simple, where if you want to launch a chain as a layer 2 technology on top of Ethereum, or a layer 3 technology on top of Base, for example, you can use the Arbitrum stack. There's just a 10% profit share on transaction fees. Blackbird, for example, has utilized Arbitrum on top of Base, probably the most and Degen Chain are probably the two best examples who've done something like that. Robinhood, Plume, Corn are examples of chains that have done this on top of Ethereum using the Arbitrum stack. And the way it works is, in order for us to make sure that we can maintain alignment, earn a business off of all the innovation generated by Arbitrum, there's a 10% profit share that again flows directly on chain into the DAO's treasury controlled by token holders. The thesis behind this is, because we want to continue to invest and make sure that we can customize this technology to support all of our builders, we need to make sure that this work is going to be sustainable. Robinhood is a great case study to describe what we've discussed in terms of Arbitrum as a platform. So for those of you who may not be familiar, in June, Robinhood announced that their tokenized equities product is going to be available to their users through their app in the European Union. Today, those equities live on Arbitrum One. Because when we started discussions with them, they knew that they had two things they wanted to do. One is they really wanted to get tokenized equities out as fast as possible. The second thing they knew they wanted to do is long-term they wanted to build a chain and an ecosystem around disrupting Robinhood as a company and bringing it on chain. But those timelines didn't match. When they were looking at different partners, they said, if we launch tokenized equities here and want to launch a chain elsewhere, we're likely going to have to move later. But with us, they were able to build a robust ecosystem where it would be justifiable for them to launch tokenized equities to start. And our team is working with them on a migration strategy for building their own chain over time so they don't have to be worried about the product focus and they can take their time doing this. And again, once they move into their own chain, the Robinhood chain will pay a 10% profit share to the Arbitrum DAO. I think this is a great case study in how Arbitrum as a platform has been able to support them. Another big factor for them was stylus. Robinhood is not a crypto company. They have Solidity developers, they have a ton of work that they do on chain, but the overwhelming majority of their engineers, the people who build the trading platform, don't write in Solidity. And for them, the ability to eventually move those things in languages like Rust or C or other languages that they're utilizing internally that can compile to WASM was a very helpful advantage from both a planning perspective in terms of recruitment and broadly how Arbitrum operates. The thing I want to talk about now is the second half, is the builders, is the support, and is the business. So we spoke about the technology, the platform, and the natural resources of revenue generation. But that demand unlocks a ton of opportunity, and what I like to call economic zones of opportunity. And what does that mean? We want to build a result where we can support builders and partners while sustainably growing the business. And the key to this is the ability to retain those earnings from what I had called the natural resources. None of this works without that. And these are three examples of existing opportunities that are strategic highlights of how we've thought about this approach within Arbitrum. The Stable Treasury Endowment Program is a great example. When BlackRock reached out to us that they were going to launch their first money market fund, the thing that was very obvious to us immediately was twofold. One, everyone's going to do the same thing. Two, there's no natural demand for this product on chain. Like the number of people, I always like to joke, that want to hold money market funds in their portfolio and want those assets on chain is like 0 people in the world, right? Until you get more utility for these assets, until these assets integrate into DeFi, it's very, very light on the demand side. But our thesis is we want to be at the convergence of TradFi and DeFi. That's where Arbitrum sits as a platform. So how do we support that in a way that we can bring more of these partners on chain and be good partners to them until natural demand is ready? So what we did was, and it's very simple, we bought a lot of their product. This allowed us to diversify out of ETH and ARB. It allowed us to generate a form of yield, and it also signaled to them that we are important partners. It was actually, honestly, like amazing to me that you got BlackRock, Franklin Templeton, Wisdom Tree, like going on the Arbitrum forums and talking about their products. But that's a key strategic component. We were able to take our retained earnings, leverage our growth, diversify the treasury, and bring a new form of yield into the Arbitrum DAO portfolio. Another great example is the Arbitrum Gaming Ventures. Support for gaming and consumer is a very important component of what we do. The reality is, if you sit where we do in the stack at the blockchain layer, particularly for gaming, consumer is a little less because there's more trading involved. Nobody wants to pay transaction fees, and there's no transaction revenue that's going to be generated. Very little at best. But how do you support this category sustainably while also ensuring that business can be supported? So we built the Arbitrum Gaming Ventures Fund. It's a separate team of about 7 people with a ton of venture in gaming and consumer experience, and they were funded by the DAO, and their mandate is find the best teams that fit this consumer and gaming mandate and invested them at the equity or application layer. We want them to be building on Arbitrum. We want to support them in a sustainable fashion. So the structure of this is a little bit complex. It took a lot of tax planning. But the high-level way to think about this is the Arbitrum DAO is the LP of this fund. It's no outside money. It's not third-party venture investors like other ecosystems might do. This is a way for the Arbitrum ecosystem to take its revenue from natural resources, fund an entity in a vehicle that can support builders in a way that's actually natural. So when we have teams that want to launch orbit chains, we're not just modeling, oh, how much transaction revenue share are we going to get in at 10%? Because nobody wants to pay transaction fees. We will likely, I mean, there's examples where we don't, but we will likely have a strategic investment to ensure that Arbitrum is able to support them in a way that the economics align with the success of their business. The last one is a similar strategy. It's what we call the Arbitrum DeFi Fund. We've taken about, today it's about $100 million worth of revenue that's been generated out of Arbitrum, and we have a team that's deploying that into Arbitrum DeFi. We want to make sure that we can support the liquidity needs of early stage builders. We want to make sure that we can generate yield and that we can continue to compound this flywheel of what we're trying to build. And this is sort of the impact of where we're at today. The on-chain assets that the Arbitrum ecosystem owns is about, majority of it's still in ARB, all on-chain, but the Arbitrum DAO has generated about $165 million in ETH and stable assets, in addition to their liquid investments through the AGV. And the goal is to continue to compound this flywheel. The way we think about this is there's 2 halves of the whole. We have very high gross profit margin businesses that are continuing to generate transaction revenue through time boost, AEP, and transaction fees. How do we take that, support builders in meaningful ways that actually help them solve their hardest problems and do so sustainably in a way that can continue to support the building of the Arbitrum DAO broadly? So with that, I just want to say, thank you very much for listening, and that's the basis of Arbitrum Everywhere. I don't know if I'm supposed to take questions or not, but I'm happy to.
If Ethereum charge you 15% or 20%, would you still be sustainable?
It's a great question. We're always going to be sustainable. The way to think about this on a net gross profit margin basis is, let's say $1 of transaction fees flows in. There's a market for how much it costs to post to Ethereum. Today, that market clears at about 3% of our costs. So if it cleared at 15% of our costs, our gross profit margin would just be 85%. But there's also, the important thing to understand is that's a second market which we can always adjust. If Ethereum charged us 90%, there's one of 2 things would happen, right? People would leave posting to Ethereum because it would not be worth it, and Ethereum is very aware of that. I'm not saying Arbitrum would do that, I'm just saying that's how the market would probably play out. Or we would just adjust our margins by charging more, right? So instead of charging $1, we can charge $2, and then our market clearing price is now again going to be 60%. So these markets are very dynamic in nature. Again, like I said, personally, I think Ethereum is undercharging. I've been very public about that. I've told the Ethereum Foundation myself. I don't think they would ever charge 90%. Before 4844, for context, the average was about 70%. So there's a huge gap, and this is why I said you went from a 70% business to a 3% business. That was probably too much of an overcorrection, in my opinion. And again, I want Ethereum to have a sustainable business too, because I think this L1, L2 roadmap is actually the best architecture for builders.
Okay, I will be very fast. So first of all, congrats. You did a wonderful panel. I would like to have a question about the last part of the panel. Let's say we are a protocol on Arbitrum, and right now I would like more to have an understanding on how you deploy and use your treasury. But putting in the, let's say, deploying in the protocols. I mean, how the protocol can apply to this kind of.
Yeah, so it depends on the vertical. If you're a DeFi team, so it used to be that everything was like on the forum and it was utter chaos. And what happened is we've been streamlining it so that there's different teams that have different roles and responsibilities. So the DeFi fund, for example, is being actively managed by the Entropy team. The Arbitrum Gaming Ventures is being actively managed by that team. And then the Arbitrum Foundation manages other grant initiatives that are sort of beyond the DAO's treasury. Like this is the assets that sit within the DAO's treasury, for example, versus the foundation, which was funded with a 7% of the original token supply, vesting over 4 years. So they do separate initiatives. This is more representation of the actual business versus like the foundation component.
I see. Thank you.
Thank you, everyone, for listening.